Looks like the Fed's trying to thread the needle. I mean, they're trying to have it both ways, which, look, they just want to give themselves as much latitude as possible, right?
They're buying time. It goes back exactly to what we talked about, is this balance of risks. As John mentioned, is they don't really know how to assess those risks. The reality is you have a lot of factors that they have to evaluate. For example, dollar strengthened this year, oil plummeted this year, credit spreads blew out, the markets are down, and all of that, even though is right now not translating into the employment numbers, if it will start to translate into employment numbers via the confidence channel, we won't know this now. We might know this by March.
Yeah.
So the service employment, I think, will be key to watch.
Let's take a look at the Dow right now. I'll tell you what the markets think of this statement before we let Mr. Russolillo go here. Down 18 points. So, I mean, not a huge move. You're probably going to see a lot of bouncing back and forth now before they take a decision. They may not even figure out what they want to do by the time the closing bell hits. But, Steve, I want to ask you, we started to talk about this before it came in. The Fed versus the markets. They didn't back off of March, as John said, but they did seem to ease off a little bit on their tone. Is this going to be enough to satisfy the markets? Do the markets want more? And are the markets really trying to push the Fed into doing something?
Well, what's really interesting about all this is that there's been a lot of talk about the Fed's credibility and how the Fed is kind of moving the goalposts at a pretty regular pace here. But also, what's just as important, if not more important, is the fragility of the markets right now. And so the fact that
you get diplomatic way to put it.
The fact that you get a 25 basis point rate hike last month and the markets go crazy, even though that was probably the most well telegraphed rate hike of all time, it just shows that the tough spot here that markets are in right now. And so getting back to Anastasia's point, when you have the dollar strengthening at the pace that it is right now, it's filtering over into the economic data. You're seeing manufacturing has been really struggling recently, and if that continues, that's going to be another warning sign for the Fed.
And Anastasia, I want to get your take on this, because look, you're on the street, I'm sure you talk to people around the water cooler. Yes. A big question that we're seeing here on our end of it is that people are saying December was a mistake. It was too soon. They shouldn't have raised, or some variation on that. What do you think of that, and what are you hearing on that?
Clearly, we're hearing several different opinions. My opinion is that it was not a mistake based on the facts that they have stipulated that they're going to act on. What they've said is that they needed the predominance of evidence, the preponderance of evidence to act, meaning there's been cumulative improvement in the unemployment rate. And there's been a lot of improvement in the unemployment rate. At 5%, I think they had to make that first step. But as I've always said, and as I will say today again, is until there's more economic momentum, there's not going to be a whole lot of rates momentum. So, for example, if you look at vehicle sales, if you look at retail sales, all of those things are picking up in absolute numbers. But if I calculate year over year change, it's actually been declining. So where's that momentum? Until we see that, we're not going to see rates momentum.
Yeah. All right. Anastasia Amoroso, J.P. Morgan Funds, Steve Russolillo, ahead of the tape columnist. I want to thank you both